People don't usually pay attention to the quiet moments in finance, the small, almost invisible shifts that barely make the news. But in hindsight, those are always the clues. A tiny adjustment in the bond market, a single line in a central bank speech, or a sudden spike in global gold purchases, and suddenly, 5 years later, everyone looks back and says, "How did we not see it coming?" Today, the US dollar is showing those same quiet signals, subtle pulses that hint at a coming shift. Not an overnight collapse, not a sensational doomsday headline, but something far more real and far more important for investors who know where to look. Before we go deeper, this video is for educational purposes only and is not financial advice. The strange part about the dollar's current moment is that nothing looks wrong on the surface. The US still has the world's deepest capital markets, treasuries are still considered the safest collateral on earth, the dollar remains the backbone of global trade, energy pricing, and cross-border finance. But if you zoom in, if you look at what the biggest economic players are doing, rather than what they're saying, you'll notice a pattern forming. It's small, it's slow, and it's the type of trend that only becomes obvious when it's already too late to benefit from it. For decades, the dollar's dominance wasn't just an economic fact, it was almost a law of nature. Nations held dollars because everyone else held dollars. It was a self-reinforcing loop. But when systems remain dominant for too long, people stop questioning them. Investors become complacent. Governments assume the status quo will last forever. And that's usually the moment when change begins, not with a dramatic announcement, but with quiet diversification. To understand why the dollar's role might change soon, we need to start with something that most investors overlook. Global behavior is shifting, not global ideology. Countries aren't suddenly anti-dollar. There's no global revolt. Instead, nations are preparing for a future where the US doesn't act as the single anchor for the entire global economy. And the evidence is everywhere, hidden in trade agreements, reserve allocations, central bank actions, and the rising use of alternative payment systems. What's interesting is that this isn't happening because the dollar got weaker. In many ways, it's happening because the rest of the world is getting stronger. Emerging nations are becoming less dependent on the US economy. China, India, the Middle East, and parts of Africa are developing more direct trade routes with each other. Technology is changing how cross-border payments work, and geopolitical alignments are shifting in ways that make countries more cautious about relying too heavily on a currency they don't control. Consider something that unfolded quietly over the last few years, the rise of non-dollar trade settlements. A decade ago, it barely existed outside a few small agreements. Today, major energy producers have experimented with pricing deals in yuan. Some nations have started to settle bilateral trade in their own currencies. Central banks around the world have increased their gold holdings at the fastest pace in modern history. None of these actions destroy the dollar today, but they build parallel rails, alternatives that didn't meaningfully exist before. For investors, the key is not to view this as a sudden end of dollar dominance. That narrative is too dramatic and ignores the structural strength of the US financial system. Instead, think of it like gravity. The dollar will still pull most of the world toward it, but the pull won't be as exclusive. The world might slowly shift from relying on one massive anchor to multiple smaller ones. And as more anchors appear, global capital starts to behave differently. To see why this matters, let's zoom out for a moment and walk through how the dollar became so dominant in the first place. It wasn't just because of the US economy. It was also because the world needed something stable, something predictable to rebuild trust in global trade and finance after the chaos of the mid-20th century. The dollar offered scale, safety, and clarity. The US had the largest economy, the strongest industry, and the deepest bond market. Every piece of the puzzle fit perfectly. But now, decades later, the puzzle looks different. The world isn't rebuilding anymore, it's diversifying. Global growth doesn't come from a few countries, it comes from dozens. Financial markets aren't limited to Western institutions. They've expanded across Asia, the Middle East, and Latin America. Technologies like blockchain-based settlement,
real-time payment systems, and digital currencies have introduced alternatives to traditional dollar-based systems.
This creates an environment where the dollar's role can shift, not because it becomes weak, but because the world becomes more balanced. One of the most overlooked signals of this shift is how global reserves are allocated. Central banks used to hold massive amounts of US dollars because there was no equivalent asset that matched treasuries in safety, liquidity, and accessibility. But the share of global reserves held in dollars has gradually declined, not collapsing, not crashing, but gradually eroding. And central banks aren't moving heavily into euros or yen. They're diversifying into a mixture of currencies and, importantly, gold. Gold doesn't pay interest. It doesn't generate yield. It just sits there. But in a world where geopolitical tensions rise and financial systems become more fragmented, gold becomes the one asset that sits outside national control. When central banks start buying gold aggressively, it's a signal, not that they're abandoning the dollar, but that they're hedging against a future with multiple financial centers. Another major signal comes from energy markets. For decades, oil being priced in dollars reinforced the dollar's global role. But in recent years, several large producers have begun experimenting with non-dollar pricing in bilateral agreements. These are not global shifts yet, but they're previews of what could happen if the world becomes more multipolar. Energy is a powerful force because it sits at the center of global trade. When energy producers diversify their settlement currencies, it sends ripples through the entire financial system. Then there's the rise of digital payment systems. Not flashy cryptocurrency speculation, but government-backed networks designed to make cross-border transactions faster and cheaper. Systems like China's CBDCs, India's digital payment infrastructure, and regional settlement platforms across Asia and the Middle East are creating alternatives to networks traditionally dominated by the West. Again, these are not replacements today, but they weaken the network effect that kept the dollar at the center. What investors should watch closely isn't whether one country abandons the dollar. That's unlikely. Instead, track how often countries choose not to use dollars when they have the option. Every time a major transaction happens outside the dollar system, it creates a precedent. And precedents are powerful because they become habits over time. There's another layer to this story. The US itself is facing structural shifts that influence global perception of dollar reliability. Its rising national debt, persistent deficits, political polarization, and fluctuating interest rate environment create uncertainty. The US still enjoys unmatched financial credibility, but investors around the world are more aware than ever that they should have options. In addition, sanctions have quietly played a major role. The US has used the dollar system as a tool for enforcing global rules, but this has also encouraged some nations to build alternatives in order to avoid potential future vulnerabilities. This isn't about disagreeing with policy. It's about self-protection. When countries observe others being cut off from dollar-based networks, they realize they need backup plans. So, where does this leave investors today? It puts them in a world that's transitioning. Not rapidly, not dramatically, but steadily. And during transitions, the early signals look unimportant. Most investors ignore them because they seem too small. But sophisticated investors pay attention to the direction of change, not the speed. That direction is pointing toward a world where global reserves become more diversified, trade settlements become more flexible, energy pricing becomes more open to alternatives, and financial technology reduces friction across borders. In other words, the dollar is moving from the center of global finance to the leading member of a more distributed system. If that shift continues, investors will need to rethink several long-held assumptions. The idea that treasuries are the automatic safe haven, the expectation that global downturns strengthen the dollar without exception, the assumption that global debt markets will always rely on dollar liquidity. These may still hold true for a long time, but they may not remain universal. As we move forward, the key is understanding not just what might change, but why those changes matter. Because if the global financial system becomes more balanced,
then opportunities will appear in places that were previously overlooked.
Yet before we dive into what investors can actually do with this shift, we need to examine the forces driving it more closely. Because when you strip away all the headlines, all the geopolitical noise, and all the sensational predictions, what's happening to the dollar isn't about collapse, it's about evolution. The global system is adjusting to new economic realities, and the dollar is adjusting along with it. One of the most important concepts to understand here is network effect. For decades, the dollar benefited from perhaps the strongest network effect in modern economic history. The more people used the dollar, the more valuable it became to everyone else. As more trade was settled in dollars, it incentivized others to hold dollars. As more nations held dollar reserves, it encouraged even more trade pricing in dollars. It was a self-reinforcing cycle. The reason this matters is because network effects don't disappear instantly. They slowly weaken, and when they do, the shift is almost invisible at first. The system doesn't suddenly flip. Instead, it develops small cracks, alternative routes, new habits, new preferences, and eventually those cracks begin to influence behavior on a larger scale. To understand how these cracks are forming, consider the transformation happening in international trade. For decades, most trade between emerging markets flowed through the US dollar. Even if two nations had nothing to do with the US, they used the dollar to settle transactions because it was efficient, trusted, and liquid. But today, emerging markets are trading more directly with each other than at any point in modern history. Asia to Asia trade, Middle East to Asia trade, Africa to Asia trade, all have grown dramatically. As these connections strengthen, countries naturally question whether they need to rely on a third-party currency. This isn't about hostility toward the dollar, it's about practicality. If two nations trade heavily with each other, they may find it easier to settle in their own currencies, or in a mutually beneficial alternative. The dollar's dominance was built in a world where trade always flowed toward the US and Europe, but that world is shifting. At the same time, financial technology is accelerating this trend. Real-time settlement systems allow countries to bypass traditional intermediaries. Local currency swap lines reduce the need for dollar liquidity in certain transactions. And digital infrastructure is making it possible for nations to conduct business without routing everything through US banks and payment networks. Each of these developments reduces friction. And when friction decreases, alternatives become more appealing. Another force shaping the dollar's future is the shifting balance of global GDP. In the mid-20th century, the US represented an enormous share of global production. Today, its share is smaller, not because America has declined, but because the rest of the world has grown. The rise of Asia, particularly China and India, has created new centers of demand. As these economies expand, they naturally seek greater control over the systems that govern their trade and capital flows. This doesn't mean the dollar loses its relevance, but it does mean the world gradually becomes more multipolar. A system with several strong economic centers inevitably supports several strong financial hubs, and when financial hubs expand, currency usage diversifies. What's also important to understand is how geopolitical risk plays into all of this. Throughout history, major empires used their currencies to project influence. The dollar is no exception. The US uses financial sanctions as a tool of foreign policy. This is neither new nor expected. But the more frequently sanctions are used, the more nations consider building buffers, not because they expect to be sanctioned, but because they saw what happened when countries suddenly lost access to the global financial system. This awareness creates incentives. Countries begin asking themselves, should we have a backup plan? Should we reduce dependency on a system someone else controls? These questions don't lead to immediate, dramatic action, but they lead to small, consistent changes like diversifying reserves, establishing non-dollar payment systems, and strengthening regional alliances. For investors, what matters most is not the political narrative, but the economic behavior. And the behavior is clear. Nations are hedging. They're not exiting the dollar system, but they are reducing vulnerability by building parallel structures.
The next major factor is the US's internal fiscal landscape, something every serious investor should monitor. Rising debt levels alone don't necessarily threaten the dollar. Many developed nations carry large debts. But what concerns global markets is the trajectory.
Persistent deficits, increasing interest costs, in a political environment where long-term financial planning becomes more difficult. When a country is deeply trusted globally, its debt levels can remain high without shaking confidence. But even trusted nations face pressure when the rest of the world becomes more economically independent. Investors no longer have to rely on a single safe haven. They can diversify across different assets, regions, and currencies. And when alternatives exist, the dominant player must work harder to maintain trust. This is why major institutional investors around the world have started paying closer attention to how the US manages its fiscal and monetary policies. High interest rates strengthen the dollar in the short term, but they also increase debt servicing costs. Low interest rates reduce costs, but they weaken yields for foreign holders. Either approach requires trade-offs, and those trade-offs influence how the world perceives dollar-denominated assets. Another subtle but important shift involves the structure of global debt. For many years, emerging markets borrowed heavily in dollars. This created demand for the US currency, but also exposed those countries to currency risk. Over the last decade, however, a growing share of emerging market debt has been issued in local currencies. This reduces reliance on dollars and reflects a broader trend. Emerging markets are becoming more confident in the stability of their own financial systems. Even global corporations are adapting. Multinational companies increasingly use regional currencies for transactions, especially in Asia. This isn't because they distrust the dollar. It's because local currency operations reduce exposure to foreign exchange volatility. When corporations change behavior, the ripple effects can be enormous. The financial system slowly adapts to meet their needs. But perhaps the most overlooked factor in the dollar's evolving role is psychological. Confidence plays a massive role in currency dominance. The stronger the belief that a currency will remain dominant, the more people use it, reinforcing that dominance. But over time, when enough small changes accumulate, people begin to reassess their assumptions. They begin to imagine a world where the dollar is still powerful, but not alone. Once that psychological shift begins, behavior follows. It's the same phenomenon that happens in technology. A platform dominates for a long time. Everyone assumes it will stay number one. Then smaller competitors emerge. At first, nobody pays attention, but as these alternatives improve and gain users, people slowly shift. The dominant platform remains important, but it no longer controls the entire market. That's the type of transformation we're seeing with the dollar. Not collapse, but competition. So what should investors watch most closely? Several key indicators offer insight into where this trend is headed. One of them is the percentage of global trade invoiced in dollars. If that percentage declines steadily over the next decade, it will signal a real shift. Another indicator is the composition of global reserves held by central banks. Slow diversification away from the dollar suggests long-term structural changes. Investors should also pay attention to the development of regional payment systems. If countries successfully build efficient mechanisms for settling transactions without relying on dollar-based infrastructure, the impact could be significant. Additionally, shifts in energy pricing could reshape global currency flows. While the dollar is still dominant in energy markets, even small changes in this area could have major consequences. Finally, watch the behavior of large, influential economies. If major players like China, India, and the European Union take further steps to reduce reliance on the dollar in strategic sectors, the trend towards multipolarity will accelerate. The biggest changes in global finance often start quietly within policy decisions that seem technical but are deeply impactful. Understanding these forces is essential not just to predict currency trends, but to identify opportunities. When global systems shift, capital doesn't disappear, it relocates. And investors who understand these movements early are the ones who position themselves for long-term advantage. Because once you recognize the forces reshaping the global monetary system, the next step is understanding how these forces actually ripple through markets, industries, and investment decisions. Investors often watch the dollar as a simple index, up or down, strong or weak. But the deeper story lies in how and why the dollar moves, not just the direction.
When the global financial system becomes more multipolar, volatility behaves differently. Correlations between currencies shift. The sensitivity of emerging markets to U.S. interest rates changes. Dollar strength or weakness no longer affects every region to the same extent. And this is where many investors get caught off guard. They assume old relationships will hold forever. For example, there was a time when a rising US dollar almost always meant pressure on emerging markets. Their debts were largely denominated in dollars, so a stronger dollar made repayments more expensive. It created stress, capital outflows, and lower growth. But as more countries issue debt in local currencies, the dynamic changes. A stronger dollar doesn't automatically spark the same level of instability as before. Though it still matters, the impact becomes uneven. This unevenness is a defining feature of the new global system. Changes no longer produce uniform outcomes. A shift in U.S. interest rates may trigger capital moves in some regions, but not others. A geopolitical event may strengthen the dollar, but simultaneously boost the use of alternative settlement channels. The world becomes a more complex place, and investors need a more nuanced view to keep up. One of the clearest examples of this new complexity is how central banks behave. For decades, they primarily accumulated U.S. treasuries. It was simple. Treasuries were liquid, safe, and trusted. But over the last several years, something interesting has happened. Central banks, especially in emerging markets, have dramatically increased their purchases of gold. This uptick isn't because gold suddenly became a better yield-producing asset. It's because gold serves a purpose the dollar doesn't: neutrality. It's the one major store of value with no political or jurisdictional attachment. When central banks accumulate gold at record levels, they're signaling something significant. They're telling the world that a more diversified reserve strategy is not simply a preference, it's becoming a necessity. The behavior of central banks often foreshadows structural shifts. They're among the most conservative institutions on Earth, and they rarely make rapid or emotional decisions. When they move slowly and deliberately. So when they diversify away from the dollar, even gradually, it's one of the strongest indications that the global system is rebalancing. This doesn't mean central banks are abandoning the dollar. Far from it. The dollar still represents the majority of global reserves. But the diversification trend shows that trust, while not broken, is no longer singular. This subtle shift in confidence is one of the earliest indicators of long-term transformation, and investors should pay very close attention to it. Another area where the dollar's role is evolving is global trade financing. Historically, Western banks, especially large U.S. and European financial institutions, dominated this field. They provided the funding, the credit lines, and the letters of credit that made international trade function smoothly. But recently, new players have emerged. Asian banks, Middle Eastern institutions, and regional development banks have grown more active in trade finance. This diversification matters because trade finance is one of the hidden engines of currency demand. When banks in a region begin financing trade in their own currencies, those currencies naturally gain influence. And once businesses become comfortable using them, network effects begin doing their work. What many investors overlook is that global financial systems often change not because of ideology, but because of convenience. Businesses choose what minimizes cost and risk. Governments build systems that reduce vulnerability. Banks use currencies that make transactions simpler. If a more decentralized global system becomes easier and cheaper to operate within, the shift becomes inevitable, even without major political statements or announcements. Now, let's address one of the most misunderstood elements of the dollar's future: the role of U.S. monetary policy. The Federal Reserve remains the most influential central bank in the world. Its decisions spread instantly through global markets. But as more countries strengthen their own financial systems, they become slightly less reactive to U.S. policy changes, slightly more independent. And that subtle independence gradually shifts how global capital flows. For example, when the Fed raises interest rates, the dollar typically strengthens as investors seek yield. But if emerging markets maintain solid fundamentals and offer competitive yields in local currency, investors may not exit those markets as quickly. The result?
a world where U.S. monetary policy is still powerful, just not overwhelmingly so. Investors need to understand this as a long-term trend, not a short-term cycle. The more the world evolves into a multi-center system, the less absolute control any single institution or country holds. This evolving landscape also introduces new opportunities and new risks. For instance, commodities might behave differently than they did in the past. If energy producers diversify the currencies they accept, the flows supporting the dollar shift. Commodity cycles might decouple slightly from dollar cycles. Regions that used to be highly sensitive to U.S. policy might find themselves more insulated, while others may become unexpectedly exposed. Global equity markets could experience more regionalized performance. In a unipolar world, U.S. market cycles often dictated global equity sentiment. In a multipolar world, strong performance in Asia or Middle East might carry more independent weight. Investors who pay attention to regional fundamentals rather than assuming all markets will move together will have a significant advantage. Beyond markets, this shift also affects multinational corporations. Firms with global operations need to rethink their currency risk management. Hedging strategies might change. Supply chains may evolve based on which currencies become more prominent in trade routes. Profit repatriation strategies could adjust to minimize exposure to volatility. But perhaps the most important impact for investors is psychological. For decades, the dollar was a constant, something investors rarely questioned. It was the baseline assumption for global financial behavior. But now investors are beginning to view the dollar as a powerful component of a broader system rather than the system itself. This shift in mindset changes how people interpret risks, evaluate opportunities, and build long-term strategies. It also changes how investors react to crises. In the past, global uncertainty almost always triggered a flight to the dollar, and this still happens today, but it's becoming more nuanced. In certain scenarios, capital may flow toward gold, or regional safe havens, or currencies with strong fundamentals. The U.S. remains a core safe haven, but not the only one. This diversification of trust is one of the clearest signs of a world moving beyond absolute reliance on a single financial anchor. All of this raises a critical question. What does the dollar look like in this future system? Not weak, not obsolete, and certainly not irrelevant. The dollar will likely remain the world's most important currency for decades. The depth of U.S. capital markets, the stability of its institutions, and the scale of its economy ensure that. But dominance will look different. Instead of commanding near total reliance, the dollar will share the stage with other influential currencies. This shared stage creates a more adaptable world, but also a more complex one. There will be fewer absolutes, more variables, more shifting relationships. To navigate that world, investors must shift from binary thinking to strategic awareness. Instead of asking, is the dollar strong or weak, they should ask, which nations are building alternative systems? Which currencies are gaining influence? Which sectors benefit from a diversified global financial structure? Which assets hedge against a multi-currency future? These are the types of questions that position investors ahead of the trend rather than behind it. And it's not just about currencies. It's about the reshaping of global power, geography, technology, and financial architecture. The dollar is one piece of a much larger puzzle, and understanding the direction of that puzzle is where long-term advantage lies. Because once investors understand that the world is shifting toward a more distributed financial structure, the critical question becomes, what should they actually watch? What signals matter? What developments aren't just noise, but real indicators of where the dollar and the global system around it is heading? To answer that, we need to identify the forces that silently shape currency dominance. These forces aren't always dramatic. They rarely appear in headlines. They're buried in economic reports, policy changes, capital flows, trade agreements, and balance sheets. But for the investor who knows where to look, they form a roadmap to the future.
One of the first indicators to track is global reserve diversification. This metric reveals not just what central banks say, but what they truly believe.
Whenever a central bank shifts even a small portion of its reserves, it signals a strategic reassessment. This isn't impulsive behavior. Central banks move slowly, after long deliberation, and usually only out of necessity. When dozens of central banks gradually accumulate more gold or increase the share of other currencies, they're effectively voting on the future structure of global finance. But reserve diversification isn't just about gold and alternative currencies. It's about the pace. A slow, steady trend means the shift is structural, not emotional. Investors should monitor how broad the trend is, not just how large. If 20 small countries diversify, it sends one message. But if major economies suddenly shift even 1–2% of their reserves, that sends a much louder one. A second indicator is the currency composition of global trade invoices. This is different from trade volume itself. Trade volume tells you who is buying and selling goods, but the invoice currency tells you how trust flows. When a company in Brazil buys machinery from India and chooses to invoice in a non-dollar currency, it's because the cost, convenience, or predictability favors that choice. These decisions accumulate quietly, and each one slightly weakens the network effect that keeps the dollar at the center. Investors often miss how powerful invoicing trends are. Currencies gain influence not because governments support them, but because businesses choose them. Corporations don't care about geopolitics, they care about reducing friction and mitigating risk. If the global invoicing share of the dollar slowly declines, that's one of the clearest signs of long-term change. A third indicator is cross-border payment infrastructure. The world is steadily building new rails, faster, cheaper, more connected networks that operate outside traditional systems. When countries develop direct payment links, they bypass intermediary currencies. These developments don't make the news often, but they reshape the world underneath the surface. For investors, the key is understanding the pattern. Whenever countries build new payment systems, they're building independence. Not necessarily independence from the dollar, but independence from fragility. The more financial rails exist, the less any single currency dominates by default. A fourth signal is cross-border currency swap agreements. These agreements allow countries to trade with one another using their own currencies rather than relying on dollars for liquidity. Swap lines act like safety nets. They ensure smooth trade even when global markets are turbulent. Over the past decade, the number of swap agreements outside the dollar system has increased dramatically. What matters most is not the scale of individual agreements, but the network they create. Every new swap line strengthens regional financial links, which gradually reduces the global dependency on U.S. liquidity. Investors should also watch which countries extend swap lines most aggressively. It often reveals their strategic priorities and long-term vision. A fifth indicator involves energy pricing behavior. Energy is the bloodstream of the world economy. Oil, natural gas, and critical minerals are among the most traded commodities on Earth. And for decades, the dollar has dominated these markets. If even a small portion of global energy trade shifts to alternative currencies, the impact is magnified, because energy markets influence everything else: transportation, manufacturing, supply chains, inflation. The key isn't whether the entire world stops using the dollar for energy. That's highly unlikely. Instead, the question is, do major energy exporters experiment with non-dollar pricing? Do buyers accept it? Does it become routine in certain regions? These experiments can create new pathways that eventually become standardized, and when an alternative payment route becomes standard, it becomes powerful. A sixth indicator is corporate treasury behavior. Global businesses are some of the most important players in the currency system because they handle enormous volumes of international payments. When multinational corporations change their hedging strategies, diversify their currency holdings, or adjust their supply chains based on currency considerations, it signals real change. Corporations are pragmatic. They won't shift to new practices unless it's economically beneficial.
Investors should watch how global companies allocate their cash reserves. If corporate balance sheets begin showing a more mixed currency composition, it signals a broader confidence shift. While central banks are slow to move, corporations react faster. Their behavior can serve as an early warning system for larger trends. A seventh indicator is the behavior of global sovereign wealth funds. These investment giants, many of them located in the Middle East, Asia, and Scandinavia, manage trillions of dollars. Their decisions influence bond markets, real estate, equities, and long-term infrastructure investment. When sovereign wealth funds diversify into new regions or reduce exposure to U.S. debt, they reveal their expectations for the future global order. These funds think in decades, not months. If they gradually allocate more capital toward Asia, emerging markets, or alternative asset classes that are uncorrelated to the dollar cycle, it indicates they anticipate a more balanced financial system. That moves us to another critical indicator, the direction of international debt issuance. Historically, countries and corporations issued large amounts of debt denominated in dollars. It made sense. The dollar was stable, trusted, and liquid. But as local financial markets develop, more borrowers prefer to issue debt in their own currencies. This reduces risk for them and reduces their dependence on the dollar. Investors should examine not just how much debt is dollar-denominated, but how that percentage changes over time. A slow decrease, year after year, suggests the world is gradually building the infrastructure for a multi-currency debt market. This has enormous long-term implications for the dollar's role. Another subtle but important indicator is how countries respond to crises. In the past, global shocks almost always triggered massive flows into the dollar. And this still happens, but the magnitude is changing. Investors should watch whether future crises result in the same overwhelming rush into dollar assets, or whether capital disperses more broadly into gold, alternative safe haven currencies, or regional assets. This behavior will reveal whether the world still sees the dollar as the singular safety anchor or as one of several. Then there's technology-driven currency innovation, something that is developing far faster than traditional finance ever expected. Digital payment systems, next-generation settlement platforms, and central bank digital currencies, or CBDCs, are all emerging. The key isn't whether a digital currency replaces the dollar. That's not the goal. The key is whether technology reduces the structural advantage the dollar gained from being the most easily accessible global currency. If cross-border digital systems allow faster, cheaper transactions in local currencies, then the dollar's monopoly on convenience gradually weakens. Investors should pay attention to large-scale digital infrastructure projects, not as threats to the dollar, but as indicators of a shifting landscape. But beyond all these technical signals, there is one overarching factor investors must never ignore: confidence. Every currency system in history has been built on trust. Trust in stability, trust in rule of law, trust in liquidity, trust in institutions. For nearly a century, the United States has earned that trust, and the dollar became the cornerstone of the global economy. Confidence doesn't disappear overnight, but it can evolve. Countries may continue to trust the dollar deeply, while also trusting other systems enough to diversify. And that diversification changes the structure of global finance. Investors should monitor global surveys, policy speeches, economic forums, and long-term strategy documents, not for bold announcements, but for subtle language shifts. When countries speak about independence, resilience, or multipolarity, those words reflect genuine sentiment. The world is reshaping itself, and these conversations reveal its direction. Now, how do these signals translate into practical implications for investors? They point to a world that is gradually decoupling from old assumptions, a world where diversification becomes more valuable, where emerging markets grow more stable, where commodities may behave differently, where regional financial hubs gain influence, and where technological infrastructure competes with traditional systems, and where the dollar remains strong, but not alone. This means investors need to broaden their field of vision. They need to look beyond the U.S. economy to understand global cycles. They need to pay attention to shifting trade patterns, supply chains, capital flows, and infrastructure investments. They need to examine how regions behave during periods of volatility. They need to track which assets perform well in a world where financial gravity is slightly redistributed. Most importantly, they need to recognize that the coming years may reward those who think globally, not just geographically, but structurally. Because the dollar story isn't ending, it's entering a new chapter, and that new chapter offers opportunities for those who are prepared.
Even as these cross-border systems expand and more countries experiment with alternative settlement methods, the dollar's gravitational pull hasn't disappeared. But here's the key. Gravity doesn't vanish all at once. It weakens gradually, almost imperceptibly, until one day, an apple that once fell straight down suddenly lands just a few inches to the side. And in the global financial system, those few inches can be the first signal of a larger shift ahead. As we move deeper into what analysts now call the multipolar currency environment, investors are wrestling with a new type of question. Not, will the dollar collapse, but how will the dollar evolve? Because the thing about reserve currencies is that they don't retire quietly. They transition. They morph. They reorient around new realities. And right now, those realities center on three forces: political alignment, technological innovation, and national economic strategy. This is where the next chapter of the story begins. The real-world consequences for investors who are trying to navigate an environment where the dollar remains dominant but less unquestioned, where alternative systems exist but aren't yet fully trustworthy, and where uncertainty doesn't just move markets, it defines them. To understand where investors should focus, consider how the financial world behaves when a long-standing assumption starts to fray. For decades, markets operated on the belief that the dollar is the dollar, untouchable, unrivaled, indispensable. That confidence allowed the U.S. to borrow cheaply, trade efficiently, and enforce sanctions that had real teeth. But the moment that assumption is tested, even slightly, every decision in global finance has to be recalibrated. Not abandoned, just recalibrated. For example, central banks don't suddenly dump their dollar reserves. Instead, they start reducing their pace of accumulation. They diversify marginally, almost invisibly. They allocate a little more to gold. They settle certain trades in other currencies as a test, not a replacement. And because global finance is a system built on relative comparisons, each small diversion chips away at the dollar's total share, not because there's a better alternative, but because the world no longer wants to be tied to one option. This is why one of the most important things investors should watch is behavior, not official statements. Countries rarely announce we're reducing our reliance on the dollar out loud. They simply shift their actions. They build new infrastructure. They negotiate new bilateral agreements. They accumulate new forms of reserves. They use gold as a hedge, not a relic. And markets notice. The investors who track these behavioral shifts, the quiet, incremental moves, are the ones who usually react before the headline arrives. Another underrated signal is how the U.S. itself treats the dollar. Because ironically, the biggest threat to the dollar's influence doesn't always come from foreign competition. Sometimes it comes from domestic policy. When the U.S. government increases debt without a clear path to stabilization, when political gridlock repeatedly pushes the nation toward default scares, when sanctions are used more frequently and broadly, or when internal inflation reduces purchasing power, these are the moments when investors and nations start thinking, maybe we should have a backup plan. Not because they expect the dollar to fail, but because they can't rely on certainty anymore. Now, uncertainty by itself is not enough to dethrone a global reserve currency, but it is enough to push the world into building alternatives. And those alternatives, whether successful or not, reshape the overall landscape. The presence of options changes the psychology of markets, which is arguably more powerful than any single economic metric. This is where technology enters the picture. Digital currencies, especially CBDCs, introduce something that didn't exist before: a payment system that bypasses traditional rails entirely.
Not just faster or cheaper payments, but a brand new architecture that reduces reliance on correspondent banks, SWIFT, and even some aspects of dollar settlement. Countries aren't building these systems to replace the dollar immediately. They're building them to avoid being trapped by it. For investors, that means the question is not what will replace the dollar tomorrow, but which systems are being built today that could reduce the dollar's influence in very specific areas. For example, energy settlement, cross-border trade financing, commodity trading, regional trade blocs, and digital payment ecosystems. None of these alone will dethrone the dollar, but each can redirect a small percentage of global flows. And when enough small percentages add up, they form meaningful change. This brings us to one more critical angle: psychology. The dollar's strength has always come from confidence, not blind faith, but rational confidence built on decades of stability, liquidity, and global acceptance. But confidence is fragile. It doesn't disappear overnight, but once it weakens, even gradually, investors begin to position differently. They hedge differently. They store value differently.
That's why the rise of gold demand among central banks is so important. Not because gold is replacing the dollar, but because gold acts as insurance against a world where the dollar is still strong, just less predictable. Think of it like carrying an umbrella. You don't carry one because you expect a storm. You carry one because you want to be prepared if the sky changes. And right now, the sky is changing. Not violently, but noticeably. Another subtle but powerful force is generational transition. Older financial institutions were built during an era when the dollar's dominance felt permanent. Younger institutions and emerging economies are growing up in an era where currency strategy is multipolar, competitive, and diversified by default. They are not emotionally attached to the dollar. They are strategically pragmatic. They are open to flexibility. And flexibility often becomes habit. For investors, that generational mindset shift is a major signal. It suggests that long-term trends will not look like the past 50 years, even if the next few decades still feature a dominant dollar. So, what does this mean for investors who want to navigate the landscape intelligently? It means keeping an eye on structural changes, not dramatic predictions. Specifically, 1. Watch global reserve allocation trends. Not the headline numbers, but the direction. Are reserves slowly diversifying? Are gold purchases increasing? Are non-dollar currency reserves becoming more common? 2. Monitor cross-border payment infrastructure. CBDCs, regional payment networks, and new settlement rails will reveal which countries are preparing for optionality. 3. Follow geopolitical alliances. Currency shifts often follow political realignments. Nations that deepen energy, trade, or defense partnerships may also diversify currency exposure. 4. Observe global debt markets. If more countries begin issuing bonds in their own currencies or in alternatives to the dollar, that signals structural change. 5. Track U.S. domestic fiscal policy. Because the dollar's role is not just about global competition, it's also about the U.S. maintaining credibility. 6. Look at investor hedging patterns. Rising long-term allocations toward gold, commodities, or non-U.S. bonds can be early indicators of shifting expectations. None of these signals predict a sudden transformation. Instead, they outline a long arc of gradual evolution, a shift that unfolds through many small adjustments rather than one dramatic moment. And this is where disciplined investors excel. They observe slow changes before they become undeniable trends. As the world moves into this next phase of global finance, investors face a set of questions that no generation has fully confronted before. What happens when the dollar is still dominant, but not alone? What happens when alternatives exist, not as replacements, but as competitors? What happens when technology creates pathways that never existed in the old financial system? And what happens when global trust must be earned, not merely assumed? These questions don't point to crisis. They point to transformation, a transformation that is slow enough to study, but fast enough to matter. The important thing is recognizing that a shifting landscape doesn't always signal danger. Sometimes it signals opportunity. When the world's financial architecture evolves, investors who understand the deeper forces shaping it often find themselves in a stronger position than those who react only to headlines. Because the truth is this:
The dollar's story is far from over. But the next chapter is different from the last. It's more dynamic, more competitive, and more shaped by technology, geopolitics, and policy than ever before. The investors who succeed in that environment are the ones who stay informed, stay flexible, and stay prepared for a world where the familiar foundation remains, but the surrounding structure gradually transforms. And as always, before we close, remember, this video is for educational purposes only and should not be taken as financial advice. Always do your own research and consult a licensed professional before making financial decisions. Thank you for watching, and as the global financial landscape continues to shift, stay curious, stay informed, and stay ahead, because understanding these changes today may shape the opportunities of tomorrow.